Thank you. I recognize the gentleman from Michigan, Mr. Huizenga.
Thank you, Mr. Chairman. I appreciate the opportunity and for you coming in. And wanted to maybe touch on a couple of quick things and continue on that currency swaps. How far are we going to bring this along? I guess would be part of my question. How long are we going to stick into this this game to be a part of it? If Europe remains dependent on currency swaps, these same swaps become increasingly risky. Are you prepared to allow these currency swaps to wind down, or what's going to happen there? And then the short-term dollar funding in Europe seemed to be the discussion point, right? How would you define short-term versus medium-term and long-term?
I'll start. Or why don't you go ahead?
Okay. I think that what we would hope is that the European countries do the right things in terms of getting their fiscal houses in order and improving their competitiveness, so that investors start to have more confidence in the sustainability of the European Union and how all these countries are going to persist. If that happens, and if at the same time the European banks are shown to have good earnings, liquidity, and capital, then I think that the willingness of private lenders to provide dollar liquidity to the European banks will emerge very much intact. And in that situation, our swaps will be at rates that are actually higher than the market, and the swap programs will just sort of wind down automatically. This is what we saw during 2007, 2008, 2009, during the first big wave of swaps, that as market conditions normalized, the swap usage came down pretty automatically.
Well, I'm kind of curious about that because I'm looking at some information in front of me here that says interest rates on dollar loans from the ECB are around 0.6%. Interest rate on ECB charges for its euro loans is 1%. I don't have my PhD in economics. However, I can see the incentive there. I mean, why by making dollar financing cheaper than euro financing, how are they ever going to get out of that cycle?
Well, I'm not sure that I would agree with that. That's the right comparison. The 1% is to borrow euros, the 0.6% is to borrow dollars, and the alternative is to borrow dollars from a U.S. bank when the Federal Reserve is paying 25 basis points on the interest rate that we pay on excess reserves. So there's quite a bit of room between the 25 basis points we pay on reserves here in the U.S. and the 0.6% on the dollar swap. So we would expect that if conditions in Europe were to continue to improve, that the rate at which European banks could borrow dollars would be somewhat north of 25 basis points perhaps, but below that 0.6%. So we would think that there's plenty of room in that difference for the European banks to obtain credit from private entities. And in fact, we've actually seen private suppliers of dollars to the European banks return subsequent to the large long-term refinancing operations and the dollar swap program. So it looks like the market's already starting to normalize.
But doesn't that weaken the value of the euro, what they're doing?
If you look at, I think the euro is really basically been trading in line with how the situation in Europe looks. As the European situation worsens, the euro depreciates. As the European situation improves, the euro appreciates. So it's really based on the outlook for Europe, of course, relative to the outlook in the U.S.
But help me understand, though, if a weaker euro, doesn't that mean typically a weaker Eurozone, since we have sort of flagged this off as a European issue and are trying not to get dragged into it here from the U.S. side?
Well, you're certainly right that if the European outlook were to deteriorate, the euro would probably weaken as a consequence. The good news is over the last 4 or 5 months, the euro has actually strengthened a bit because Europe has actually made some progress in terms of addressing some of their issues.
Okay, and then my time is almost up, and I know Dr. Kamen, you want to say something as well, but I'm curious, what keeps you up at night? What other countries? I mean, you specifically, I think in Dr. Kamen's testimony, talked briefly about Greece, and then you just were touching on Spain and Portugal, but where are we? Italy, Ireland, And are we on solid footing, or I'm sorry, are they on solid footing in France and Germany and some of those other countries that have been leading this?
Certainly the euro crisis in general is what keeps me up at night and what occupies much of my thinking time during the day as well. Obviously, the situation of Greece has been very difficult, and we've been following that very closely. We also obviously are very focused on basically, Ireland and Portugal, which are the recipients of IMF funds. And we think it's critically important that these problems not move further into Spain and Italy, which have also been the focus of market attention. So, and we think it's absolutely critical to make sure that you don't have further contagion beyond that. So far, things have been looking on the brighter side. There have been improvement in markets, but we have continued to monitor the situation as closely as ever. And then, while most of my thinking lately is focused on Europe, obviously I'm thinking about oil prices as well, because that is another area that poses a potential threat, at least down the road. Thank you.
Thank you. I